Welcome to Master Trader's Weekly Trade Review. I'm Dan Gibby, and in this review, I'm going to show you one of our option strategies, which we do into earnings on particular range-bound setups called an iron condor. Our approach to shorting options, whether it's into earnings or not, is we're picking direction using our technical-based approach, saying, I don't think the stock's going to go there by expiration. And then the options that we sell, the credit that we receive, is our potential maximum profit that we're earning through time decay. We are technically based option traders, and there's some people out there who say nobody can pick direction. We obviously vehemently disagree with that. We have 85% batting average on picking direction, and we use that technical approach in both buying and selling options around the charts. High implied volatility is preferred because that spikes the price for those expensive options that we are selling around the charts. And so earnings, obviously. And then after the announcement of a particular known news event, then we get huge volatility contraction. Once we're in a trade, everything's about management. When we're shorting options, we can do nothing, let them expire worthless. We stop out if the pattern isn't working. We have adjustment and hedging strategies. We can roll if the pattern still supports the initial trade. And the beautiful thing is, whether the markets are in a coma, trending, chopping, these are strategies that work all the time. This is the general picture of what I'm looking for to sell iron condors, whether into earnings or not. I want a wide sideways range with flat major moving averages. It's obviously preferred. And then we're going to be selling an out-of-the-money bear call credit spread over resistance. We're going to be selling an out-of-the-money bull put credit spread below support. But when we're doing it into earnings, you're going to see on these examples, all of which we did just last week, that we can get further away, which gives us more cushion, if you will, to be wrong in the event of an adverse gap. Here's one, EA. So look at the flat moving averages. You can see how clean our charts are. We just have red and green candlesticks, color-coded volume, and we use the 20, the 50, and the 200 for short, intermediate, and long term. So even though the stock's bouncing around here, it's in a wide, we're looking for, my partner Greg Capper calls them lines of defense. We want multiple lines of defense far away, and then we're going to have our checklist, make sure the options are liquid, we're getting adequate, I call it juice premium for the risk that we're assuming in selling these condors. And so in this particular example, this is a closed trade in members area, and you can see the history of it. So we shorted the 136, 141. Here's my 136, that's how we picked it. And I said, okay, where would I be comfortable saying, with earnings, I know it's going to gap, but I think I have sufficiently far away lines of defense, and I'm getting paid adequately for the risk assumed. In this one, it's a $5 wide iron condor, taking in 97 cents a share. One contract represents 100 shares of the underlying. So if I sell 10 contracts of this particular iron condor, $970 is immediately deposited into my brokerage account. I typed this out for subscribers. That represent a potential 24% return on capital based on max gain. Max loss is always a spread with less premium received. But that would have to be a catastrophic gap and move against us for us to get anywhere near max loss. We've never taken a max loss in our history. And I give the break-even stops, which are the short strike plus the premium, short put minus the premium received. So we have a huge break-even. I give the obligatory disclaimer: don't take this unless you understand what we're doing. We have adverse cap risk. We don't hide anything, but we're very successful in doing these. In fact, this quarter earnings alone, just over the last 3 weeks, were 30, I think 7 for 38. So this particular, where I have the arrow, you can see it opened relatively flat. That is 100% the ideal situation, because then we have no change in the option prices for a directional move against us, a gap up or down, and we are getting huge volatility contraction following the news announcement. I really, unless it's 0 DTE, day of expiration, I like getting out of these because it's earnings day, crazy things can happen. You can see the big tails here. So in this particular case, I saw it opening flat, and I initially said, hey, bid a dime to close it. I wasn't getting filled. I got filled at 12 cents, and I'm like, go ahead, take the money. So 97 by 12 cents on a 10 lot, that would be $850 overnight. Another example or two, Hilton Hotel. Beautiful, beautiful major support double bottom. Multiple lines of resistance, and notice on this one, even though I'm putting this horizontal resistant line at a 140, we went $5 higher. So we had not only all of this, but $5 more. We sold a $10 wide call spread, $10 wide put spread, and the 115 is a couple dollars below this. I pointed the day of earnings here for you, and it whipped around a little bit, went up a little bit, but see how it never violated, and this was at expiration right here. And had you held it, you see it just bobbled around in the trading range, and you would have made max profit. In this case, on a 10 lot, $1,700. Airbnb. Now, this one I see the declining 200, and it's in a trading range, though, from here to here. And that's why we considered a condor. It was only an overnight trade. And what we shorted the 125s here. So again, here's my major resistance, but we went higher to give us more cushion to be wrong. And we just take less premium the farther out we go. So we did the 125, $5 wide, and we did the 90s. So even though this had an adverse gap against us and accelerated lower, had you held it to expiration, which is this picture, you would have made max profit. But when I saw the bearish gap and it started selling off, I said, look, just close it at 10 cents, take the money. It's not worth sitting in this to try to squeeze out another 10 cents. Go to mastertrader.com/spread to trader. We have 2 courses on selling options, which is this strategy I've been talking to you about. We also buy options, whether it's into earnings or not, as a directional trade, provided the options are liquid, because of the benefits of leverage and limited risk. As I mentioned, so Q3 earnings to date, it's been 3 weeks since earnings season started with the banks. We are 37 for 38 closing gains, including break-evens on these short income trades. So that's shorting naked calls, naked puts, spreads, and of course these condors that we just talked about. Also check us out in our Master Trader Green Trading Room. My partner Greg Capper and I start at 9 a.m. every morning with pre-market review, our hit list, gap list, scanning, managing opens. It's a fantastic place to get to know us and watch us implement the Master Trader method in real time. mastertrader.com/green trial. Spend $7. You will love it. Hope you enjoyed that. Any questions, email Greg or me. Look forward to seeing you in the next trade review video.